A new financial product has just crossed $6.3 billion in size. It is being marketed to retail savers as a high-yield bank account paying 11.5%, and approximately 80% of it is held by ordinary investors rather than institutions. That product is called STRC. It was launched by Saylor Strategy in July 2025, and what we are looking at may be one of the most engineered illusions of safety we have seen in the public markets in over a decade. Now, the pitch is simple. Saylor has publicly described STRC as a high-yield bank account, as offering money market-like stability, and has explicitly said it is designed to compete with the $18 trillion sitting in US bank accounts. He has even applied a 4.49 Sharpe ratio to it, a metric usually reserved for nearly risk-free assets. But the reality is something completely different. STRC is not a bank account. It is not FDIC insured. It is not debt. It is preferred equity in a single asset Bitcoin holding company carrying an S&P credit rating of B-, which is junk, speculative grade. It has no redemption rights, meaning you cannot go back to Strategy and ask for your $100 back. To exit, you need to find another buyer in the secondary market at whatever price that market gives you. And Saylor himself has admitted this is equity while still selling it to retail savers using the language of cash. So how is the price kept stable at $100? This is where the engineering begins. The board of Strategy adjusts the dividend rate every single month to manipulate demand and keep the share price near par. When demand weakens and the price drops, they raise the dividend. The yield has been hiked 7 times in less than 9 months, going from 9% at launch all the way up to 11.5% today. In other words, this is not a stable product. This is a product struggling to maintain an artificial peg, and the dividend hikes are the tell. And despite all of this engineering, STRC has already broken below par multiple times, trading as low as $90.52 in November 2025 and around $93 in February 2026. Now, the real question is, where is the 11.5% actually coming from? Strategy's underlying enterprise software business generates approximately $475 million in annual revenue. The annual dividend obligations across their preferred stack are estimated at roughly $904 million for 2026. That is nearly double what the operating business produces. So the yield is not funded by earnings. It is funded by the continuous sale of new STRC shares to new retail investors, whose money is then used to buy more Bitcoin, which props up the Bitcoin thesis, which then justifies issuing more STRC. This is a closed loop. The battery powering this perpetual motion machine is new retail money. And every link in this chain depends on Bitcoin continuing to cooperate. Strategy now holds roughly 780,000 Bitcoin at an average cost basis near $75,000 per coin, with $8.25 billion in convertible debt sitting senior to STRC in the capital stack. If Bitcoin declines 50 to 70%, the dividend can be legally suspended, which is not a default, which means there is no legal recourse, and retail is left holding a dividend-free equity instrument worth a fraction of par. We have seen this exact playbook before. In 2008, auction-rate securities were sold to retail investors as cash equivalents, paying above money market yields. When the auctions failed in February 2008, hundreds of thousands of investors were trapped in instruments they had been told were safe. And in May 2022, Terra Luna's Anchor protocol offered roughly 20% APY funded by circular token emissions. When confidence broke, $40 to $50 billion vaporized in days. The structural pattern is identical. Above market yield, no organic revenue backing, a peg maintained by belief, and a retail investor base that does not understand what they actually own. Now, this does not mean you should panic and dump every yield-bearing position you hold, but it does mean the entire architecture of marketed safety in the crypto-adjacent corner of the market deserves serious scrutiny. The opportunity, as we see it, is in the opposite direction. Hard assets with transparent cash flows, productive businesses where the yield is funded by actual revenue rather than capital recycling, and instruments where you legally own the underlying rather than a derivative exposure to it. Energy infrastructure, base metals, and uranium-linked equities continue to offer real yield backed by real economic activity, and these sectors are completely overlooked by the same retail capital currently being absorbed into engineered yield products like STRC. The warning signs to spot in any high-yield crypto-adjacent product are clear. Yield that exceeds what the underlying business can organically generate, stability maintained by human discretion rather than structural backing, no redemption rights, junk credit rating dressed in bank-like marketing, and an 80% retail ownership base that institutions are deliberately avoiding. When something is sold as too good to be true, the question is never whether you want the yield. The question is, who is paying for it, and why are they working so hard to make you believe it is safe? Thank you for watching.